fast. And Hong Kong's turned, and there's very little construction. It's a very constrained place, and real estate values here will come back and be at their peaks at some time in the future.
Great. I hope that future is very close. All right. So
I wasn't talking about your apartment.
Okay. So one last question for Samara and for Jim, right? So we talk about data center, energy. It seems to be that we're assuming there's unlimited capitals available out there, right? But in reality, who's going to fund those big investments? We knew that institutional investor has always played a very important role, including the sovereign wealth funds. But is retail have to be part of that picture, and how we look at that sort of, the supply side of the capital?
Okay, sure, I'll go first. So look, basically there are hundreds of trillions of pools of savings in individuals, in institutions, in governments out there in the world, and I think what we do as asset managers is we connect those savings with investment opportunity where we have expertise to deliver superior risk for the return. What we've been seeing is that pools of saving moving much more from markets like equities and fixed income into private market type assets, the less liquid assets. And that is happening initially through the institutional channel, but now through the retail channel, there are growing mechanisms, intermediated wealth, or now we talked about the 401ks in the US to allow retail to access this. Also, insurance is looking to allocate more to these higher return potentially, but more illiquid and maybe more complex risk assets. So I think what we do is act as intermediaries where we each have our expertise to bring those pools of capital to investments through unlisted markets, listed markets. I mean, Bruce, you have a structure with listed entities at the top using listed markets. A lot of people use unlisted. We're moving more into insurance and wealth. And I think basically, the allocation overall is shifting where people are getting more comfortable taking the risks. Now, we do have to think about the illiquidity risk, particularly as we do this with unsophisticated investors and make sure they're looked after as they go into this. But I think we are seeing more allocation to private markets. And I'll let Jim have the last word.
Jim?
Watch the private markets here. If you remember the 2000 tech bubble, we were actually right that the internet was big, but too much money was trying to go into it. 20 pounds of money was trying to go in a 5-pound sack. Same thing might be happening in the public markets now. But while that public market bubble happened in 2000, over in the private markets, we were creating Amazon, Google, later Facebook. So the business models are what to focus on here. Who has the best business model? If there's a good business model, capital is not the thing I worry about.
Great. So we're running out of time, and let's put our hands together and give this three panelists a round of applause. Thank you.
Thank you very much, speakers. Please remain on stage for a quick photo. Please look straight to our official camera. And now it's towards the back for our media friends. Thank you very much, speakers. You may now return to your seats. Technology is set to transform the financial sector. Our next panel will explore how the latest innovations will disrupt and revolutionize the way financial services are delivered and what the future holds for industry as a whole. Let us give a warm welcome to our moderator, Ernesto Torres Cantu from Citi, and our panelists, Jenny Johnson from Franklin Templeton, Danielle Pinto from JPMorgan Chase, and Bill Winters from the Standard Chartered Bank.
Very good. Good afternoon, everybody, and thank you, HKMA and Eddie, for another wonderful event. Being in Hong Kong for 123 years, actually, Citi, we've been, witnesses to It's transformation, it's innovativeness, and adaptation, which is certainly happening again. No? And talking about technology, and given that during all morning we have not spoken about AI, we wanted to take it to Ron's comment, to the applicability, more than the evaluation, et cetera, in that sense. And let me start with Jenny. No? Jenny, how is AI transforming, business operations at your firm, and what strategic considerations should companies keep in mind to stay competitive in this field?
Well, I think if you're not thinking about how AI is transforming every part of your business, you're not thinking broadly enough. And I almost think you have to think, what is AI not going to do in my business that we can add value by doing? And so, the challenge always with technology is the first thing that anybody looks at is you make more efficient what you do today. You get the tool in the hands of your employees, and then they start to give you ideas about how you can really make the next level of change. So right now, we're at that stage of figuring out, okay, how can we be more efficient? RFPs used to take us 18 hours to do the first draft. It's 14 minutes now. From our investment teams, if you think about it, an investment team has 3 decisions: buy, sell, size. And so we've created models within our investment teams where you put in the team's philosophy, you're looking at historical trades and data, and then as you're making decisions, it actually can challenge the investment person. So the research analyst, well, you actually say this, but now you're recommending this because there's always biases. On distribution, it's about how do you optimize the time of your salespeople. So who are they visiting, and are they having the best conversation? And all that, you obviously have the data internally to provide those insights. It takes time to hone the models, but we're looking at, really every part of our business, and obviously technology, creating code, every part of our business to try to push it forward to leverage the technology.
Thank you, Jenny. Daniel, in same concept of applicability, and also how do you see it evolving to just a productivity enhancement tool, or more than that?
So I think that as a big company, traditional company, so the way to succeed, in my view, is to look at, as Janie said, every part of a company will be challenged or transformed. But then how do you think about it? In my view is you have to think if that piece would have been AI native activity, how you would do it, and then try to get the organization to move exactly that way. So we started investing in AI like 10 years ago, and the bulk of last year, we do measure the value more or less, and we got around a couple of $1 billion in value, either cost savings or losses being avoided or revenues being produced. And that number is been growing roughly at 30–40% a year. And I think that it will accelerate. But the bulk of what has happened so far is traditional AI. We are now seeing the beginnings of the increasing productivity driven by large language models. And probably the next step will be agents and how those are going to increase not just productivity in operational processes, technology, call centers, but things like in research, enhance the capabilities of our researchers, in bankers, particularly junior bankers, that they can become a lot more productive and go and face clients a lot sooner. That instead of doing presentations that can be done, or filing things that can be done by technology. So I think that this is very transformative. I think that increasing productivity will increase the ability to customize client experience, develop products, target marketing, create client experience where the client group will be one client, and to make it really make the best for that particular client is going to be very transformative. And we are essentially at the very beginning. So I see a lot of growth, top line and bottom line going forward.
Bill, and I see you agreeing with Jenny's and Daniel's comments. No? Do you see the impact in the medium term, like it has been suggested in other panels, et cetera, or short term and immediate?
Past, present, short term, medium, and long term. I think all of the above. I do agree with Daniel and Jenny on everything that they said. I think including the fact that we were engaging in AI before we called it AI. We called it data analytics, and we used it for fraud protection and transaction monitoring and name screening and the sorts of things that large language models were very useful for. But I think, like a lot of us in the corporate world, we got excited about the technology, and you go back 2-3 years, we looked around the bank and we had thousands of data scientists and literally hundreds of AI use cases. And we then took a pause and said that's probably hundreds too many, given our ability to focus on a few things that really matter. So I mean, the approach that we took at Standard Chartered was to say, at our core, we're a bank that focuses just on two things. We're actually quite simple. We focus on the cross-border needs of our multinational clients, whether those are financial institutions or corporations or governments. And we serve the affluent populations in the markets in which we operate, which are mostly Asia, Middle East, and Africa. And my challenge to the team was, how many of those 400 use cases are existential for those two sets of activities? If it's existential, we better develop it ourselves and be very good at it. If it's not, we can get it from somebody else, or we can wait a little bit and develop that ourselves. So it's been hard to train people in on 7 to 10 top priorities for us rather than 400. And I can tell you the 400 would have gone to 800 within a year had we not channeled a bit. Now, we'll get to the 800. Many of those you can get off the shelf eventually. It might not be absolutely best in class, but it doesn't matter if it's not existential for us. If it's existential, like my nightmare, and I find our head of retail is sitting in the room right now, the nightmare for me is to wake up one day and find some really zippy fintech who's built a much better robo-advisor that can displace our RMs in an RM-led wealth management distribution model, which is highly successful for us. So if that's your nightmare, then you better have something that is keeping pace with the nightmare. That's what we've done. That's what we're doing. So we've got an excellent, I call it AI augmentation tool for our relationship managers to make them, position them as best in class. And at some point, as appropriate, we'll expose our clients to those tools, but only when they're ready for it and when we're ready for it, which is not today. That's the medium and the long term.
Very good. Thank you, Bill. Now let's move on to the other big trend, stable coins and digital assets. Jenny, you've spoken quite a bit, and clearly about the potential for tokenization and blockchain technology to transform financial services and your industry in particular. What operational challenges need to be addressed to truly unlock its potential?
What operational challenges? Well, so number one is that you have a bunch of different blockchains out there that aren't all integrated, so integration's one. Number two, so we rolled out a natively on-chain tokenized money market fund in 2021. We were fortunate in that we picked a chain, Stellar, that optimized what we were trying to do. If we had picked other chains, it would have been much more expensive, potentially more expensive than our existing money market funds. So you got to pick the right chain. There's some people that are concerned about the number of transactions per second, but actually there's certain chains that are optimized for that have that are faster than even Visa and MasterCard process. So you're working through a lot of these. But the biggest issue is probably most people don't have a wallet. You can't really hold a token if you don't have a wallet. I'm always hearing about alts managers say, can't wait till blockchain can democratize alternatives. The reality is that technology exists today. You don't have market makers. You don't have the infrastructure around it. And honestly, today, there's almost two worlds. There's the TradFi, the traditional finance world, and the digital asset world, and they're only now beginning to kind of come together. And as that happens, a lot of the traditional learnings that have happened will be brought over and much more professionalize, I think, what's existing in the digital assets. But there is no question, I fundamentally believe the infrastructure and plumbing of financial services will be replaced by blockchain.
Quite a statement. Daniel, your firm's perspective on digital assets has evolved significantly in the last years. What prompted that shift or change?
The reality that it hasn't. So obviously, you know Jamie's views on Bitcoin. That is, and he was very clear. These are personal views. For me, Bitcoin is transforming into an asset class. My concern about Bitcoin was more about if you start losing keys, so keys get stolen, it's going to destroy the confidence of this as a class. The reality, a lot of keys were lost and stolen, and here we are. So it just became an asset class that is never been is a place to store value if you believe that you will sell it at a higher price than it was. It's not a method of payment because it's slow and expensive. So it is what it is. And I think that in the big scheme of things, Bitcoin is very relevant. But the technology is, I've been working for many, many years. We launched the JPMorgan coin in 2019. But everything that the industry have done is even private networks like the JPMorgan coin. That is a very, very effective tools for clients to optimize the flows of funding, program payments, and do instant effects. And many clients are using it, working very well. We have done with Bill and other banks the Partior program that is a 24/7 network of transferring payments among banks, led in Singapore. So we have done quite a lot. And now we are at the point where we start experimenting with tokenized deposits, start experimenting into the public chain space that Jenny has mentioned, with essentially white label clients that you are approved your part. It's not that you put your coin there, your token there, and see how it goes. I think that that is the next layer. I think that tokenized deposits is an effective way to make a bit more interoperable the banking sector with the crypto space. The digitalization of assets is going to start growing. The issue in the banking sector is regulation is a big challenge. When you look at the Basel regulation and their interpretation, essentially prohibit banks to be in a public chain because the capital intensity is so huge that it makes essentially not possible to do that. So the Genius Act in the US for stable coins of certain characteristics is not going to follow, apparently, the Basel. So in which case it's possible, and I think that there are a bunch of use cases of stable coins that they are obvious, like cross-border, small value, cross-border payments. It may be a challenge for some of the existing payment systems that exist today, like credit cards or debit cards. So I think that this is, and the technology is evolving. As Jenny said, Bitcoin is super slow. Ethereum is a bit faster but relatively expensive for low-value payments. Then there are other networks that they are evolving that they are very, very fast, but they have other challenges. So as technology evolves, I think that it will be a challenge for the existing railways in payments, maybe a challenge for the way that we trade in markets as it gets digitalized. So I think that is something that is real, and it will take time until banks and the proper regulation for banks to be part of this ecosystem in a substantial way.
Bill, you've been quite outspoken about the potential for stable coins and tokenization. The market is it's small now. What would it take to go to the breadth and depth that you see in the future?
Yeah, the market is small today in traditional finance. It's, there's trillions of dollars trading in the DeFi world.
I think there were $27 trillion last year traded in stable coins. That's more than Visa and MasterCard combined. It's not that small.
Carry on.
Yeah, good answer.
No, that's all good. Just, I was defending your point, Bill.
We always agree. That's a problem. There's a ton going on. Obviously, it's anchored in the crypto world, and that's where it started, and it's growing. And as Daniel said, the technology is the same. It ports from the crypto world into the TradFi world. We're at the earliest stage of the incorporation into the TradFi world. And I think it's inexorable. I think money will become entirely digital over a period of time. That calls for an entirely new infrastructure, which is being built. It will grow out of the crypto world. It comes with tons of challenges. And how we get from where we are now to where we're going to end up is a huge open question. None of us have any idea exactly how this will evolve. And I think all of us have a high conviction that it will. Which means that we need sort of hand-in-hand cooperation with regulators and with each other in the market to create an infrastructure that's safe. And I'm going to be super sycophantic because, well, for two reasons. One is we're regulated by the HKMA. It may surprise you to know. Our name is on the banknotes. We care a lot about what happens in Hong Kong. And the HKMA has been super progressive in this area. Not because Eddie and Arthur and team have any better idea exactly how this is going to develop, but because we just know it is. So we're going to have to try different things. So tokenized bank deposits here in Hong Kong dollar stablecoins, maybe at some point a structural connection through to the RMB. Obviously not on the agenda at the moment, but it could be, and this would be a really natural place to experiment in that regard. And I think that's the way to progress from here is a little bit trial and error where the errors don't cost you the system. And but the use cases are developing around us in an incredibly fast way. And the non-bank players, of course I completely agree with Daniel's observation about the Basel rules. I think it's almost insane to allow a financial system to grow out and intentionally keep the banks outside of it. So the one entity that regulators can look through and see through and understand where the systemic risks are building up or where the operational risks are building up, we're spies, right? That's what we do. We watch markets, we report back to the regulators. It's insane to keep the banks out. Now, the HKMA obviously is bringing us in as progressively as any regulator in the world. Maybe that's going to happen with the Fed. Maybe it's going to happen with, as the Fed and the US regulators promote post-Genius Act reforms. Other places like Singapore are doing their bit. But the opportunity here is to bring the banks into the system in a safe and sound way, lest we allow the system to get too big without decent oversight.
Thank you, Bill. And let me go back to Daniel on that. If we see that moving forward, what does that do to the traditional model of financial intermediation for banks, et cetera? And how are you foreseeing that?
Well, as I said, I think that on the payment side, assuming that there is some way that regulation is not too fragmented, I think that it will have a role, stable coins will have a role in very fast, very cheap, very effective global payments and transferring money from one place to the other. I think that tokenization of deposits or tokenization of assets, if it gets to a point where it's properly regulated, is within the regulated space and is done at scale, it will change what are the current rails that we use today as in payments for markets. So I think that is way, way, way too early to know, but it feels now that probably the tide is turning from being something that we've been experimenting for years and years and doing little things. I think that now is getting to a point where most likely will escalate and hopefully escalate, as Bill said, within not just in the unregulated space, allows the regulated entities to be an important player. So therefore, if everyone will be safer in that space, and we avoid the problems that we normally have when new things come into the market until they settle down. So we will see. It's still a long way to go, but I think that is real now.
And Jenny, how do you see bank and non-banks working together, or not enough to unleash the stable coins, tokenization, etc.?
Well, I'd rather talk about blockchain than just stable coins, because I think stable coins is one, it's the current use case, but there's so many other use cases. So just kind of the question on sort of how does this impact banks? You know, if you think about today, what does this technology do? This technology has an immutable record of who owns it, right? So huge amount of money is spent in the industry reconciling data between systems and then reconciling data with the counterparty. There you have one source of truth. You know exactly when it's relevant as soon as a transaction. The smart contract can trigger it and you get paid. So if you have atomic settlement, which means you get paid, you don't have to worry about who the counterparty is because it's wallet to wallet. I don't need to go to JPMorgan Chase to do a foreign exchange contract and worry about who the counterparty is if, one, the counterparty's wallet has been approved, whitelisted, and my token can only go into that wallet, and two, the smart contract kicks off and makes sure I get paid. So there's a lot of toll takers in transactions today that get eliminated once the ecosystem is rolled out. And if you're like a title company to prove that somebody has ownership on a home, and it gets on the blockchain, you don't need to worry about going out and validating that. So I think you have to look at a transaction and say, where am I adding value and where does this eliminate? And it'll take time to happen, but I think because it drives down costs, it's much more efficient, it will inevitably happen.
Very good. And one last question, Bill. You talked about cross-border, and part of this proliferation, if you will, of each jurisdiction constructing its stable coins has a couple of things. It's the reserve currency of one or the other, and its interaction for cross-border payments, etc. How are you seeing that, Bill?
I think that's first of all, as a toll taker, I'm sure that Jenny had me and Daniel in mind.
You know exactly where you're relevant. You'll continue to be relevant in those.
The cross-border payments are the obvious use case because they've certainly for other than very sophisticated institutions, they tend to be slow and expensive, and less and less slow, less and less expensive, but nevertheless not 24/7 real time. So a lot of the use cases today are, for example, port operators who want to get the ship out of the dock on a Saturday, and they don't want to have to wait until Monday or Tuesday when the payment clears. Very, very simple use case, but a cross-border payment. It could also be a local payment. In the absence of any regulation or in the absence of any alternative, those transactions the cross-border payments will be conducted using US dollar stablecoins, right? Because they're there. There's 280 billion of them out there. They're very liquid. The people that care already have a digital wallet. They can use those stablecoins. But that isn't the world we live in. There's regulation, and many countries said, no, you can't, either a bank can't hold a stablecoin, or a user can't use a stablecoin, or you don't have a local license to engage with a local player. And that, so regulation, as is frequently the case, is the protector of the incumbent, and the incumbent is frequently a bank. So we get to charge a little bit more and be a little bit slower for a little while longer. But water makes its way through a rock eventually, even not so porous rocks. Eventually, it comes out the back end. By the way, it comes out clean. It's been filtered along the way. And so I think it is, again, inexorable that the digital asset-based or blockchain-based payments will make their way into the real economy. It's just a question of how fast. And we should be more thoughtful, and I think the HKMA is thoughtful, about how we shape that outcome rather than let it just happen.
Absolutely. Well, thank you very much, everybody. One thing is clear from our conversation is that we're not talking about the future anymore. This is present tense transformation in all of these topics. Thank you very much, Jenny, Daniel, Bill.
Thank you very much to our speakers. Please remain on stage for a quick photo. Now, please look towards the back. Thank you very much. You may now return to your seats. Thank you very much to all our speakers this morning for their sharing. Lots of food for thoughts as we go into the lunch break. Ladies and gentlemen, please enjoy your lunch, and we'll be returning to the stage again between courses for remarks by the Hong Kong Financial Secretary and a fireside chat. Thank you. Ladies and gentlemen, lunch will be served at your seats. You may remain seated, and your lunch will be brought to you. Thank you. Ladies and gentlemen, we're serving the appetizers. Please get seated. Ladies and gentlemen, we're going to serve the appetizers very soon. You may now return to your seats. Ladies and gentlemen, we're going to serve the appetizers very soon. Please can you return to your seats and enjoy the lunch. Ladies and gentlemen, we're going to serve the appetizers very soon. Please, may you return to your seats and enjoy the lunch. Hello again, ladies and gentlemen. I hope you're enjoying your lunch. May I have your attention back to the stage again for remarks by the Financial Secretary. May I now invite on stage the Financial Secretary of the Hong Kong Government, the Government of the Hong Kong Special Administrative Region of the People's Republic of China, Mr. Po Chan.
Distinguished guests, ladies and gentlemen, good afternoon. A very warm welcome to the Investment Summit Luncheon. Like many of you, I'm very much looking forward to the fireside chat featuring Larry and Kent. But before we hear from them, please allow me to offer an update on Hong Kong to whet your appetite. History tells us that the world's great financial centers do not stand still. Their success depends on their ability to serve the economy, anticipate what lies ahead, embrace technological advancement, and adapt to shifting megatrends. Hong Kong is of no exception. Today, once again, we are at a moment of profound transformation, one defined by shifting geopolitics, regional integration, rapid technological advancement, and climate challenges. But these are not necessarily headwinds. In fact, they can be powerful tailwinds for those ready to respond with agility and vision. At the heart of our response is an elevated role for Hong Kong as a super connector and super value adder, one that connects market, capital, innovation, and opportunities across borders and regions. That role is being shaped by a few converging forces. First, a global shift from globalization to regionalization. Trade and economic cooperation within regional blocs like Asia are gaining momentum. We see this in the expansion of frameworks like RCEP and CPTPP, and most recently, the FTA 3.0 between China and ASEAN. These developments are reshaping global trade and investment patterns, and Hong Kong stands at a strategic position. Second, many economies are actively seeking diversification, be it economy, market, sources of capital, supply chain, and others. The Middle East, for example, is increasingly looking eastward. Trade between the Gulf and emerging Asia has been growing at some 7% annually over the past decade. And trade between Saudi Arabia and China is expected to surpass that with the West by 2027. These statistics reflect not merely a change in trade flows, but a structural shift in strategic orientation and cross-border cooperation. Third, China's development must be reckoned on multiple fronts. Despite a complex global environment, our country continues to press ahead with high-quality development. The recent fourth plenary session of the CPC Central Committee has laid out recommendations for the country's 15th five-year plan. It has reaffirmed China's commitment to high-level two-way opening up. It has placed emphasis on technological self-reliance with strong support for technology and innovation across the entire value chain. And the deep integration of technological innovation with industry development is particularly noteworthy. All of the above developments are elevating Hong Kong's role as a two-way platform for trade, investments, and technological collaboration. As part of the national strategy, mainland enterprises are being encouraged to go global in the attempt to reconfigure their supply chain and industry chain. As they do so, they look to Hong Kong not only for capital, but also for a full suite of high-value services. At the same time, capital is floating to this part of the world too. Investors' optimism has grown, particularly since the DeepSeek moment earlier this year, where the technological powers of China surprise the global investment and tech communities, and their valuation is very attractive. Separately, we have noticed strong interest in our capital market from the global south. They are seeking capital to support their ambitious infrastructure and economic development plans. Middle East is a good example. Last year, we strengthened cross-border collaboration with Saudi Arabia, full mutual listing of ETFs, tracking each other's market. Now we will soon welcome the first Middle Eastern company to list on our stock exchange. In fact, our financial regulators have already signed agreements, MOUs, with their respective counterparts for cross-border regulatory collaboration, paving the way for more companies to list here or to do a dual listing on both stock exchanges. Another important development in Hong Kong is our ambition in innovation and technology. Over the years, we have made over $200 billion in related investments and laid out a clear strategic roadmap to nurture technology and innovation as a new engine of growth, from supporting basic and translational research, nurturing startups, to attracting global and mainland enterprises and talent to Hong Kong, and rolling out special initiatives to promote advanced manufacturing. The aim is to integrate technology and innovation with industry development. Our focus is on 4 areas, namely AI and data science, biotech, fintech, new energy, and new materials. And the carrier of this vision is the Northern Metropolis. And if I may use AI, one of the key areas of focus as an example, to elaborate a little further, we adopt a twin engine strategy, developing AI as a core industry and promoting AI as an enabler to upgrade traditional sectors. We call this AI Plus. Our strategy rests on 6 pillars: computing power, algorithm, data, application scenarios, capital, and talent. Apart from building a supercomputing center and experimenting with cross-boundary flow of data and biosamples from the mainland to Hong Kong, we have been all out to attract leading companies engaged in cutting-edge technologies. So far, we have attracted over 100 such enterprises. This is supported by a vibrant ecosystem of some 4,700 tech startups. Many of them are based in our Science Park and Cyberport. As to talent, we have modified our various talent admission schemes since the end of 2022. Today, we have received more than 540,000 applications, approved about 360,000 of them, and more than 240,000 individuals have already arrived in Hong Kong. Of course, these technology companies need capital to scale beyond the full spectrum of funding options available, from angel investors to IPO. We have established the Hong Kong Investment Corporation as patient capital to channel private capital into sectors that we would like to develop, such as deep tech, biotech, and green tech. Ladies and gentlemen, Hong Kong's story has always been one of reinventing itself. Time and again, we capitalize on our unique strengths under the one country, two systems framework and ride through the waves of changes and challenges with determination, agility, and perseverance. Thank you all for walking this journey with us over the years. Your support has been highly appreciated. I wish you all an enjoyable luncheon and a thought-provoking conversation ahead. Bon appetit.
Thank you, Financial Secretary, for your words. Ladies and gentlemen, please continue to enjoy your lunch. We'll be back for fireside chat. Thank you. Welcome back, ladies and gentlemen. It is time for our fireside chat. It's our pleasure to welcome Larry Fink and Ken Griffin, the founders and leaders of two of the world's most successful and innovative financial institutions. From the early days of their ventures to the present, they will walk us through what drove them to start their companies, how they navigated changes and challenges, and what lies ahead of their organizations. Without further ado, please join me in welcoming our moderator, Howard Lee, from the Hong Kong Monetary Authority, and our two speakers, Larry Fink from BlackRock and Ken Griffin from Citadel. Howard, over to you. Thank you.
Of course. Now, good afternoon, everyone. I hope you have enjoyed your lunch. And we have had a full morning of discussion. We are trying to make it a special way to really conclude the very insightful discussion today. And you can see that we have two CEOs who are always in the thick of shaping the markets. Larry Fink, co-founder, chairman, and CEO of BlackRock, and Ken Griffin, founder and CEO of Citadel. Both have moved billions, it should be trillions, and moved the needle of how the financial industry thinks, acts, and adapts. Now, I would go for Larry first. Now, Larry, BlackRock has really grown through multiple market cycles and adapting to changes while holding to a very clear mission. How do you think about staying true to your purpose while evolving the business models and meet new clients' needs? And you are making big moves in acquisitions. And is it a pivot or a modification of your mission? Or how do you sort of explain the different philosophy going through different parts of your building of your business?
Well, it's nice to be in Hong Kong. Thank you, Howard. Eddie, thank you. It's great to be on a panel with Ken. Actually, BlackRock has been invested with Ken since 1995. And I think it's now up to about, what, $1.5 billion that we have. So it's been a great partnership between BlackRock and Citadel. Our mission has never changed. I mean, everything we do, we focus on behalf of clients. The whole ideal is to be, if we could provide a better service to our clients, a more consistent service to our clients, we could ultimately win more share of wallet. And that's how we look at it. So our job is to provide them with information and also having them focus on the long term. 54% of the assets we manage are retirement assets. So I don't really care about the day-to-day travails of markets or geopolitical issues as much as how do we accomplish the mission of trying to achieve a long-term pool of money on behalf of the clients so they could earn the trust of their clients and their retirees. And so as we have expanded from once was it just a bond firm, actually just a mortgage firm when we founded it, to a bond firm, then we used our currency to grow and to be additive. It is probably two big insights that we had over the years was when we acquired BGI and iShares in 2009, we were highly ridiculed. That most people said you can't have passive and active under one common platform. And I said, well, our clients have both of that. If we could provide a unified platform in which we could move across the spectrum of passive and active, we could provide a better service. And then over the last 10 years, we've seen the augmentation of the private markets. And so in the acquisitions that we did was another just a statement saying, with now better risk technology, we're seeing more and more clients just move around the liquidity spectrum of public and private. And so to me, this is just a natural addition to what we're doing on behalf of clients. And through that, I mean, probably the biggest reward or feedback loop that what we're doing on behalf of clients is obviously the scale of the firm, over $13.5 trillion of client money. But we went public now 26 years ago, and for 26 years, our compounded return to our shareholders is over 20%. For 26 years compounded return of 20+% for our shareholders. So it's validated both by our clients and validated to our shareholders.
Okay, thank you, Larry. Let me turn to Ken. And now Citadel has also gone through journeys at different juncture, the volatility in 1990s, and then you are now becoming the best or most successful hedge fund in the world. And during these years, was there any moment that you feel that you have to really think of pivoting in terms of your investment style, your risk management, your talent growth, and then or is it that you started off with this vision in mind and then you consistently drive your implementation?
So the hedge fund manager gets to start with his train wreck, is what you're saying.
Yeah.
Because that would be 2008. Let me take a huge step back. So what do we do at Citadel? We manage money on behalf of endowments and pension plans, wealthy families, medical institutions around the world. And it is a pleasure to be here in Hong Kong. Our 35th anniversary was this last weekend. We've been active in the markets here in Hong Kong for about 34 of our 35 years of existence. So it is great to be here as we now start our 35th year of being in business. The business that we're in is absolute return. We try to earn a return that's uncorrelated to the market. So very low beta, very low directionality in the portfolio. And over the course of the 35 years, in general, volatile periods have actually played to our strength. Of course, was the great financial crisis of 2008, when having a very levered balance sheet placed us in a very precarious position as financial institutions around the world. Many banks were enduring substantial losses and were forced to reduce the amount of wholesale funding they were willing to engage in, which caused a number of price dislocations in the market that traditionally had fed our success to become instant liabilities. So I know that there's a great emphasis here in Hong Kong on the regulation of the systemically important banks. That's actually very important to every single market participant. Thoughtful regulation of banks around the world underpins the vitality and strength of our financial system. And it is impressive to see HKMA's constant focus on how do you improve regulatory standards around the world, and in particular here in Asia. So 2008 was our darkest moment, and in some sense, to not try to make light of it, but we went from being in the storage business, owning a portfolio of cheap assets, financed with very cheap borrowed funds, to the moving business, trying to find more liquid assets, less leverage, a faster speed of realization of the alphas in the portfolio. We went from storage to moving. And that did require us to change our mix of strategies. So for example, a much, much bigger focus on the trading of equities or foreign exchange, where you have far deeper and more liquid markets.
Okay. Now, you talk about changing market situation. Of course, you navigate through these changes very well and then becoming what you are today. But we are now, perhaps like sometime in the past, seeing evolution of new asset classes, new phenomena like meme stock and crypto, and the euphoria on AI investment. And you talk about market rationality in the past. So do you see the current situation, the pretty strong investment in AI, so to speak, and really something that really leave the market a little bit less rational, and then how would investor see this and navigate this? And everybody's worried about missing the opportunity, missing the big boom. But again, the valuation, the amount of investment is really mind-boggling. What do you think? Crypto, AI, and all that?
Well, I think markets tend to be most irrational in their extremes, in the heights of a bull market and in the depths of a bear market. And right now, we are very deep into a bull market in many of the major economies around the world. There's a sense that very little can go wrong, and there's great enthusiasm amongst investors. So, in some sense, your speculative fevers, your FOMO, fear of missing out, will from time to time triumph common sense. And regretfully, humans will exhibit the same behavior in a bear market. They'll tend to panic out of very good investments at the very wrong moment. These are the behaviors that we as people have. And again, they tend to be exempt or magnified at the two extremes of the market cycle.
Okay. Now, I turn back to Larry. We just mentioned briefly about the hype about crypto and all of that. I know BlackRock and you have some view about crypto, but you're really into tokenization, and you feel that tokenization has the future. How do you link the two, and how do you see tokenization being something that might rewrite the kind of rules for financial markets and financial transactions going forward?
So most of BlackRock's business is a business of hope. You know, why would Earth anybody invest for a 30-year outcome like retirement, unless you're hopeful that in 30 years the outcome is better than keeping your money in a bank account? And so I look at everything we do is around giving hope. And I do believe hope prevails in most circumstances. You know, if you go back to even the year 2000, and you invested in equities, let's say the S&P, and then there was a 40% downdraft in 2001. But if you invested in equities in 2000 and kept it until today, your compounded return would be about 8%. So despite the financial crisis, despite the dot-com boom, despite COVID, and if you kept your money in a bank account, you would earn 1%. So I just start with that framework that most of the foundation of BlackRock is to try to give hope to people about the ability to invest over a long horizon. And I am an optimist that I do believe all the noise and all the ugliness we read, we actually mitigate most of it as human beings. And I do believe over a long period of time, hope prevails. Now, that being said, there is a role for gold, and there's a role for Bitcoin, which I believe are assets of fear. You own these instruments if you're frightened of the debasement of your currency. You own it if you have financial insecurities, or you own it if you have physical insecurities and worries. So that's one of the foundational issues of my journey in understanding crypto more. But today there's about $4.1 trillion sitting in digital wallets, growing very rapidly. It has caught attention to people around the world. A lot of men and women who are actually fearful of keeping all their money in their currency or storing it in their country where they live. But beyond that, the opportunity for tokenization is probably the most important component of how we are going to see the evolution of the financial plumbing of the world. There's just too many middlemen in so many different areas. Jenny talked about it earlier, but there's just way too many middlemen in the process. And the reality is, if we could tokenize all our ETFs, all $5.3 trillion of our ETFs, and provide that in a digital wallet, you could seamlessly, without fees, going from a digital currency or a stable coin or whatever that may be in your digital wallet and buy bond or stocks. And I believe that is going to be the future. I do believe more transactions are going to be done digitally. with authentication of ownership. Now, obviously, you know, should the whole financial system be on one blockchain? What does that mean? How, you know, how do we protect ourselves? So there are obviously a lot of things we have to address to make that work. But I do see more and more of a future of having more and more financial assets being digitized, sitting in a singularity of a blockchain, and going from cash to stocks to bonds back and forth, doing that seamlessly. And I do believe that is going to happen sooner, not later.
Well, thank you, Larry. I think that's a perfect entry point for me to do a little bit advertisement for Hong Kong. We have a project ensemble, which are getting some name internationally, which really aims to provide a pretty unified and good platform interconnection for different asset layers and then different payment means, whether it's stablecoin, central bank money, tokenized deposit, and whatever, and hopefully to create a seamless system for everyone. So I encourage you and your firm to really
we'll be standing right
join
next
hand
to you.
with us. And okay, now you both built very successful businesses, and talent, I'm sure, is one of the key things that you would have to consider through your journey. I would like to turn to Ken, and now you hire very bright minds, and I heard some people said that, okay, they proud themselves as being the smartest person in the room, and then they can figure out all the algorithm, all the market situations. But with the advent of IT, AI, and Gen AI, and all that, and do you think eventually AI would take more share of human being in decision making and sort of make your people feel, okay, I perhaps no match for a super AI? And then how do you think talents are going forward in the world of increasing competent AI?
So first of all, if you were in the room at Citadel, you would quickly realize that being bright is just the ante to be in the room. But to stay in the room, you have to actually work extraordinarily hard. The world's financial markets are incredibly competitive. They don't reward just IQ, they reward resourcefulness, they reward perseverance, they reward just good old-fashioned hard work. You know, we'll do about 30,000 management meetings this year to try to understand the business models of the companies that we invest in around the world. That's how we create value for our clients. And an AI engine isn't going to do that. Yes, it can help us to accelerate the research process, but it's not able to displace the insights of our top or even our junior investment professionals. It's a source of leverage day in, day out in terms of the ability to quickly assimilate and gather information. But if you know what everybody else knows, you know nothing that distinguishes you as an investor in the market. Great investors are those who are able to see what will unfold. They can predict what will change, what will develop, what will happen in a way that an AI model is just not trained or prepared to do. So I'm not worried about the job security of my colleagues at Citadel with the rise of generative AI. I do think that generative AI will create value for society as a whole. We see it already in call center automation, in translation of documents, and we do need to prepare to retrain members of our workforce to accommodate this rapidly shifting job environment. But for most people who are engaged in trying to forecast or predict what will happen in the future, it will be another research tool, but it will give you supporting information, but not the conclusion.
So you do not expect AI would lead to a reduction in workforce, at least perhaps not in financial institution like yourself, or whether there would be a change in skill set required to perform the function with the AI assistance?
So we very carefully look at how AI is impacting the market for jobs. And remember that the United States and much of the world engaged in a tremendous amount of labor hoarding during the pandemic. So companies were unwilling to let people go, were willing to let their workforces grow. Remember, we had a booming economy, tremendous monetary and fiscal stimulus, and a moment in time where companies had really strong pricing power, which manifested itself, for example, as inflation. So what you've seen is you've seen corporate America unwilling to shed jobs. Now the economy has lost a little bit of that tailwind. There's a sense today that continued automation and digitization will allow us to be more efficient. And there's no doubt the C-suite, the Chief Information Officer, Chief Technology Officer, has a bigger voice. In corporate America, embracing the power of technology is now willing to reduce the rate of new college hires. You see open job recs really coming down. But this is not due to AI per se, it's due to a reversal of the labor hoarding that's taken place and a belief that just applying technology writ large will allow us to be more efficient and more productive.
Oh, very good and pretty reassuring for some of our colleagues. Now, I would like to, the next part of the question, I would like to turn to closer to home and spend some time on Asia. Now, Larry and BlackRock has been a big player in the Asia market for many decades. If you were to give one piece of advice to a US institutional investor regarding the Asia allocation for the next decade, what would it be?
Well, I do believe that the coming decades will be more of an Asia story, whether it is the educated workforce, the work ethic, and the lifting of so many economies here in Asia that will be rising relative to other places in the world. And so with that, you will see more and more allocation to Hong Kong, to other parts of Asia. And I think that's just a natural progression. I think in addition, I expect to see more Asian countries to have a more robust retirement system. Because if you think about one of the fundamental successes of the United States and why US equities typically trade at higher PEs is because the scale of our retirement system, of this Pillar 3 self-directed retirement systems. And that is a fundamental foundation why US equities have done so well. If you just look in Asia, look to what has happened over the last close to now 2 years in Japan, with NISA accounts now having the ability to doubling the size of tax exemption allocation to retirement, and you've seen the attendant growth in Japanese equities. This is a story that we are talking to every government, not just in Asia, but everywhere in the world. For a great economy, whether it is every country in Asia or everywhere else in the world, a great economy means having a great banking system and a great capital market system. And in most economies, you have a strong banking system and a very weak capital market system. And that's one of the fundamental reasons why Europe was so late in rebounding after the great financial recession, because they had a very poor capital markets. And it took them a long time to offset the increased capital standards of banks, and so there was a sucking out of capital. And so for my optimism in Asia is all about the expansion of its self-directed retirement systems here, the opportunity to not only just attract international capital here, but importantly, to have more self-directed investing in your country. What I try to tell everybody, and I tell a lot of government leaders, you don't want your population to invest in your bonds, because that means your population is renting. You want your population to grow with your economy. And the way you grow the economy for most people is investing in the equity markets of your country. And I believe that is going to be the real theme in the future. If we want to broaden economies, and right now we're seeing a narrowing of economies, we're seeing a narrowing. We need to see more, especially in an AI world where you're going to have 4 or 5 hyperscalers worth $8+ trillion. We need to find ways to broaden the economy, and the best way of broadening the economy is expanding the retirement systems for more self-directed opportunities and investing back in your country. And by doing that, you will see wealth that is broadening across the entire economy.
I see. Now, I want to go to Ken on this Asia question, but I want to bring it even closer to home. I know you are expanding your Asia operation, and you are also expanding your Hong Kong office a lot. So I really thank you for that. But can you explain a little bit why you find Hong Kong the place for you to really further explore Asia, and what are the plus and minuses you see Hong Kong in offering a platform for your expansion?
Well, I think Larry just hit on the key point, which is Asia has tremendous human capital. If you look at the global financial leading cities in the world, New York's 1, London's 2, Hong Kong's 3. Why is Hong Kong 3? The depth of human capital here in Hong Kong. And that mirrors the depth of human capital across all of Greater China, whether it's in finance, whether it's in engineering, whether it's in biotechnology. This is a region of just incredible advancement and development, which is creating value for corporations at an almost unprecedented rate. So we've been in Hong Kong now for 2 decades, and we greatly appreciate the depth of talent that is here in this region. The second key element that drives Hong Kong's success from the eyes of a foreigner is that Hong Kong is the gateway to mainland China. We've been an active participant on Hong Kong Connect for years. It's been a huge success story. The combination of Hong Kong Connect, the long-standing relationships with the Hong Kong banking system, and the trust in the Hong Kong judiciary system makes Hong Kong a natural point of connectivity for firms outside of China into both Hong Kong and into mainland China. And then, of great importance, Hong Kong continues to be open to bringing people from around the world to live here and to enrich the talent base of this region as need be for firms that are growing quickly. So if there's a particular expertise and we need to hire somebody who was born in Australia or who was born in Western Europe, we can bring them to Hong Kong. Hong Kong is open and willing to let people call Hong Kong home. And that's really important when you have a workforce of both locals and people who are from abroad.
Well, thank you very much, Ken. This is really very encouraging. Now, time is running up, but I cannot let you two go without asking a slightly unorthodox question, because you guys talk a lot about your business, your personal journey. But taking the opportunity of you both on stage, can I ask you both to talk about one thing you really admire both of each other? Admire most of each other. Maybe Larry, you'll go first.
Larry, we hugged each other to start.
Oh, wait. What I admire about Ken is you know, I've been on panels with him many times, and I've learned quite a bit just listening to his responses to questions, but more importantly, I admired how he built one of the greatest financial services companies in the world. It is amazing to watch how you went from a startup hedge fund to now you know, one of the most iconic hedge funds, but the other businesses you built, the whole trading platform. And I think Ken early on saw the vitality and necessary, especially after the financial crisis when banks had higher capital standards, that there was a need for more algorithmic trading platforms to assist us. So as ETFs grew, the need for market making to make sure that our clients who were buying ETFs had as low a tracking error as possible. And Citadel is one of the real leaders in this. And so watching Ken, first of all, as a friend, we invested with him, but more importantly now, we use Citadel as one of the major platforms on behalf of BlackRock to making sure that the buyers of iShares ETFs get the lowest tracking error in terms of the bid-ask spread. So, you know, the resiliency of Citadel and Ken himself is is really one of those special things for me to watch. I'm going to be, next year I'll be in finance for 50 years, so it's, I can't say that about too many people.
Okay, Ken, your turn to reciprocate.
Well, thank you. Thank you, Larry, for the kind words. One of the most remarkable stories of BlackRock has been how humble the firm has been as it has become the unequivocal, just extraordinary success story in asset management around the world. I mean, it's incomprehensible, the scale of BlackRock today, managing almost $13 trillion, and the leadership that BlackRock has manifested both in active and in recent decades, truly the leadership in passive investing, which has brought to retirees a far more cost-effective way to save for their golden years. I mean, it transforms the lives of tens of millions of people, the work that BlackRock does each and every day. But one thing that I will say that is remarkable about BlackRock is not just its prowess in asset management, but the remarkable story of Aladdin, which signifies that BlackRock is truly a leader in multiple disciplines, because Aladdin is the platform that powers so much of the world's largest financial institutions, largest sovereign wealth funds, with a technology platform that gives some of the most important players in the financial markets in the world real transparency and visibility into their portfolios, and it allows them to better achieve their investment objectives. So I think BlackRock's just not only a remarkable success story in asset management, but an unstated hero in the technology of finance. And for you to have built the team that's able to conquer 2 summits like that is just a real statement to the talent that you have surrounded yourself and your willingness to empower people to really bring their A game to work each and every day in building the BlackRock success story.
You could get another hug now.
Well, we are really running out of time, and but I think everybody enjoy it. So really thank you, Larry and Ken.
I'll give you that hug.
Thank you very much, Howard, Larry, and Ken. Please now look towards the back for our media friends. Thank you very much. Ladies and gentlemen, as we come to an end of this year's summit, I'd like to take this opportunity to thank you again, our attendees, speakers, and moderators for making today's a truly fruitful summit. May I now invite Eddie back on stage to say a few closing words. Eddie, please.
Well, I know we're approaching 2:30, so I'll be really brief. I just want to thank all the speakers today for their open and generous sharing on different issues. And I also want to thank you all for participating this morning, for coming to our summit. Do come back next year. We've already set the date for next year. The main summit will be on the 3rd of November, the welcome dinner on the 2nd of November. Mark it in your diary and come back. Thank you very much.
Thank you again, everyone, for joining this year's Investment Summit.